In March of 2009, the S&P 500 hit its lowest point in 13 years. Unemployment was climbing past 8%. Every financial headline read like a warning label. And somewhere in that wreckage, a small group of investors quietly kept buying. Not because they were fearless, because they understood something the headlines didn't say. Most people treat a falling market the way they treat a falling knife. You don't catch it. You step back and wait for the bleeding to stop. That instinct feels rational. It's also exactly what costs the average investor the most money they will ever lose. So here's the question worth sitting with. If downturns are temporary and recoveries are historically inevitable, why does the fear of losing money push people to guarantee they miss the recovery? That gap between instinct and outcome is what this video is about. Because while most investors are watching their portfolio drop and reaching for the exit, the ones who come out ahead aren't doing something complicated. They're using the drop itself as the engine. And if you don't understand that mechanism, every recession becomes a setback instead of what it actually is. My name is Alex, and if you've ever watched the market fall and felt the pull to do something, anything, stay with me. Because inaction built on a clear framework is one of the most aggressive moves you can make with your money. I'm going to show you exactly why the math of a downturn favors the investor who stays in, and the 3-step system for positioning yourself to benefit from the next one. Once you understand how a market drop changes the cost of every share you buy going forward, you'll stop reading market news like a threat and start reading it like a price tag. Here's what makes that possible. A recession, stripped of all the noise, is one specific thing: a sale. Think about the last time something you wanted went on sale. Not a small discount, a real one. 30 to 40% off. The instinct wasn't fear, it was an opportunity. You either bought it or you regretted not buying it. Now ask yourself why the stock market is the only store in the world where people run for the exit when the prices drop. That's not a rhetorical point. It's the central failure of how most people relate to their own money. Here's what a recession actually is, underneath all the news coverage and the anxiety. Officially, economists define it as 2 consecutive quarters of negative economic growth. That definition gets announced, on average, about 11 months after the recession has already started. By the time it's on the front page, you've already been living in it. So the official label isn't useful. What is useful is understanding what happens to asset prices in that window. They fall, significantly, and in most cases, temporarily. The S&P 500 dropped roughly 34% during the 2020 COVID crash. It recovered completely in about 5 months. During 2022, growth stocks lost nearly 50% of their value across the year. By the end of 2024, the broad market had recovered and pushed past previous highs. The pattern isn't a guarantee, but it has repeated itself consistently enough, across enough different crises, that dismissing it requires more faith than accepting it. So if the drops are real but temporary, and the recoveries are real and sustained, then a recession isn't a threat to your financial life. It's a repricing event. The same assets you wanted at higher prices are now available at lower prices. That's the entire reframe. And it sounds obvious when you say it out loud, which makes it strange that almost nobody acts on it. Let me make this concrete. Take someone like Daniel, a project manager in his late 30s, earning around $91,000 a year. He'd been investing $500 a month into a broad index fund for several years. Consistent, disciplined, doing everything right. Then in early 2025, markets started sliding. By the time his portfolio was down 22%, the feeling in his gut was loud. He called his brother, who told him to move everything to cash and wait it out. Daniel did. He stopped contributing in February. He waited. The market bottomed in April and began recovering sharply through the summer. Daniel got back in July near the recovered prices, having missed the exact window where his $500 a month would have bought the most shares he'd ever purchased per dollar invested. He didn't lose money by selling at the bottom. He lost it by stopping the engine at the moment it was most powerful. This is what the sale metaphor actually means in practice. When prices fall, your fixed monthly contribution buys more, not slightly more, meaningfully more. If an index fund sits at $100 a share and you invest $500 a month, you're buying 5 shares. If that same fund drops to $65, your 500 buys 7.5 shares. You haven't changed your behavior at all. The market did the work for you. Every share you accumulate at $65 is a share that rides the recovery back to 100, then past it. The math doesn't care how you felt in April. It only counts what you did. Now, I want to be honest about something. This reframe only works if you believe recoveries will continue to happen. That belief isn't blind optimism. It's based on the historical behavior of diversified markets over long periods. It could change, but betting against it has a poor track record, and the cost of being wrong in that direction is steep. The bigger risk for most people isn't that the market won't recover, it's that they won't be in it when it does. And that risk isn't really about strategy, it's about something older and harder to override than any spreadsheet. Because the reason Daniel moved to cash in February wasn't ignorance. He knew the theory. The problem was that the math of what he stood to lose felt far more real than the math of what he stood to gain. That's not a character flaw. That's the asymmetry of losses. And understanding it is what separates the investors who survive a downturn from the ones who actually profit from it. There is a version of losing money that never shows up on your statement. No red numbers, no alert from your brokerage app, just a quiet, compounding disadvantage that builds in the background while you think you're being careful. That's what loss aversion actually costs most investors. And it's worth understanding precisely, because the math is more uncomfortable than most people expect. Start with the basic mechanics. Your portfolio drops 50%. Tell yourself it's temporary, you hold on, and eventually the market recovers 50%. You're back to even, right? Not even close. If you start with $10,000 and it falls to $5,000, you now need to double your money just to return to where you started. A 50% loss requires a 100% gain to recover. Those are not symmetrical, and that asymmetry means every large drawdown is significantly more damaging than it looks on the way down. This is the core reason panic selling is so destructive. It isn't just that you lock in the loss on paper. It's also that you eliminate your position for the recovery. You suffer the full damage of the drop and then opt out of the repair. You pay both prices and collect neither benefit. Now here's where the psychology enters. The research on loss aversion is consistent and has been replicated across decades of behavioral economics studies. The emotional weight of losing $100 is roughly twice as intense as the satisfaction of gaining $100. That's not a mindset problem. That's how human brains were wired long before stock markets existed. The instinct to avoid loss was useful when the stakes were physical survival. It becomes expensive when the stakes are a brokerage account during a temporary downturn. What this means in practice is that the pain of watching a portfolio fall 20% is powerful enough to override what you intellectually know about long-term investing. Daniel knew the theory, as we covered. He still moved to cash. That's not a weakness. That's the loss aversion mechanism working exactly as designed. The problem is, it's designed for a different environment than the one you're actually in. So if the asymmetry of losses is the danger, dollar cost averaging is the structural answer to it. Not because it eliminates the emotional discomfort, but because it removes the decision. You invest a fixed amount on a fixed schedule, regardless of what the market is doing. When prices are high, your fixed contribution buys fewer shares. When prices fall, that same contribution buys more. The strategy doesn't require you to predict the bottom. It doesn't require courage in the moment. It just requires consistency. Here's what that looks like with actual numbers. Say you invest $600 a month into a broad market index fund. Before a downturn, the fund is priced at $120 per share. You're buying 5 shares a month. The market drops 30%, and the fund falls to $84. That same $600 now buys you 7.1 shares. You didn't change your behavior. You didn't time anything. The lower price simply gave your fixed contribution more purchasing power, automatically. Those additional shares acquired during the downturn are the ones that generate the outsized returns during the recovery. Because they were bought cheaply, they have more room to appreciate, and they compound forward from a lower cost basis, which means every percentage point of recovery is worth more to you than it is to someone who bought at higher prices and held through. This is why staying invested during a falling market isn't passive. It's one of the most structurally sound moves available to a long-term investor. The market does the discounting for you. Your job is simply not to stop the process. There is, of course, a harder question sitting underneath all of this. Staying invested requires believing that the recovery will come. And that belief isn't just a feeling. It's something history has either earned or hasn't. So let's look at the actual record, because the historical case for holding through a downturn is more specific and more instructive than most people realize. Every generation gets a moment where the market looks genuinely broken. Not just down, broken. where the news coverage stops sounding like analysis and starts sounding like an obituary. And in every single one of those moments, the investors who stayed in look obvious in hindsight and looked insane at the time. That gap between how it feels and what the record shows is worth examining carefully, because it's where most long-term wealth either gets built or quietly abandoned. Start with the dot-com collapse. Between 2000 and 2002, the Nasdaq lost nearly 80% of its value. Not a correction, a near total destruction of an entire category of assets. Companies with real revenue, real customers, and real futures lost 90% of their stock price alongside companies that had nothing but a domain name. If you were invested in broad index funds during that period, your portfolio was cut roughly in half. The headlines were catastrophic. And then, slowly, the market began recovering. By 2007, the S&P 500 had returned to its previous highs. The investors who held through the full cycle didn't just survive. They ended up in a stronger position than those who sold and waited for certainty that never announced itself cleanly. Then 2008 arrived, and that one felt different. The financial crisis wasn't a sector correction. It was a structural failure of the banking system. The S&P 500 fell by 57% from peak to trough. Unemployment reached 10%. The fear wasn't that the market would take years to recover. The fear was that it might not recover at all. It did. By 2013, the index had fully recovered. By 2020, it had more than doubled from its 2009 low. The investors who held through the worst of it, or who kept contributing during it, saw compounding work at a scale that genuinely changed their financial trajectory. The 2020 COVID crash is the one worth studying most closely because the speed was unlike anything in modern market history. The S&P 500 fell 34% in 33 days. 33 days. That's not a slow bleed you can rationalize your way through. That's a free fall. And the recovery was equally dramatic. The market reclaimed its pre-crash highs in approximately 5 months. Investors who moved to cash in March of 2020 locked in a 34% loss and then watched the recovery happen without them. Now here is the number that makes all of this concrete. According to research from JP Morgan, tracking a 20-year period through 2023, an investor who stayed fully invested in the S&P 500 would have turned $10,000 into approximately $64,000. An investor who missed just the 10 best trading days over that same 20-year period would have ended up with around $29,000. Miss 20 days, and you're looking at roughly $17,000. The difference between $64,000 and $17,000 isn't skill. It isn't timing. It's simply whether you were in the market or out of it on a handful of days, spread across 2 decades. Here's the part that matters most. Those best days are not randomly distributed across the calendar. They cluster. The largest single-day gains in market history have overwhelmingly occurred during or immediately after periods of maximum fear and volatility. The very days when selling feels most rational are statistically the days most likely to precede a significant recovery move. Selling to protect yourself from further losses is, in practice, often a mechanism for guaranteeing you miss the recovery. That's not a coincidence. It's a structural feature of how markets reprice. The drops happen because of mass selling. The recoveries happen when the selling exhausts itself and buyers return. The sharpest bounces occur when the last sellers leave the market. If you're one of them, you miss the bounce. I'll say something plainly here. Trusting this pattern requires a degree of historical faith. It requires accepting that what has happened before is likely, though not guaranteed, to happen again. That's a reasonable position, but it's only useful if you pair it with a system that keeps you invested when your instincts are loudest. And that's exactly where the 3-step playbook comes in, because understanding the historical case is one thing. Building the structure that keeps you from abandoning it under pressure is something else entirely. Most financial advice fails at the exact moment it's needed most. Not because the strategy is wrong, because the strategy was never designed to survive contact with a falling market and a nervous investor at the same time. A plan that only works when you feel calm about money isn't really a plan. It's a preference, and preferences collapse under pressure. So the question worth asking before the next downturn arrives isn't what I should do when markets fall. It's what structure will make the right behavior automatic when I least want to do it. That structure has 3 components. They're not complicated, but each one does a specific job. and skipping any of them creates a gap that fear will eventually find. The first is a cash cushion, not an investment account, not a brokerage fund you can technically access. Liquid cash, sitting in a high-yield savings account, covering at least 6 months of your actual living expenses. In 2026, the average high-yield savings account is paying somewhere between 4 and 4.5% annually. That's not an investment return. It's the cost of having options. Because the single most destructive force in a downturn isn't fear in the abstract. It's a specific, concrete situation, needing money at the exact moment your portfolio is down 30%. When that happens, you're not making an investment decision. You're making a survival decision, and survival decisions have terrible long-term math. The cash cushion means you never become a forced seller. Your portfolio gets to keep working while you keep living. The second component is automation. Set a fixed contribution to transfer from your checking account to your investment account on the same date every month, and then remove the decision entirely. This isn't passive. It's the deliberate removal of your own judgment from the equation during the periods when your judgment is most compromised. When markets are falling, and every instinct you have is telling you to stop, the automated transfer happens anyway. The shares are purchased at the lower price. The cost basis drops. The recovery, when it comes, is more powerful because of the shares acquired during the decline. You don't get credit for discipline you didn't have to exercise. You just get the result. The third component is true diversification, and this one is worth being specific about. Owning 15 technology stocks is not diversification. Owning 4 different S&P 500 index funds is not diversification. Diversification, in the sense that actually provides protection during a downturn, means holding asset classes that respond differently to the same economic conditions. Broadly, that means a combination of U.S. equities, international equities, bonds, and in some cases, real estate investment trusts. When U.S. growth stocks fell sharply through 2022, intermediate-term bonds provided a partial buffer for investors who held both. Not a perfect hedge, but enough stability to prevent the kind of total portfolio panic that causes people to liquidate everything. This is where the pro move lives, and it's the part most investors either don't know about or don't have the stomach to execute. It's called rebalancing, and during a crash, it becomes one of the most mechanically powerful tools available. Here's how it works. Suppose your target allocation is 70% stocks and 30% bonds. The market drops 30%. Your stocks are now worth significantly less, which means your actual allocation has shifted. Maybe you're now sitting at 60% stocks and 40% bonds without making a single trade. Rebalancing means selling some of those bonds, which have held their value, and using that cash to buy more stocks at the depressed price. You are, by mechanical necessity, buying low and selling high. Not because you timed anything, because the system forced the trade. Consider someone like Rachel, a financial analyst in her early 40s, with a balanced portfolio split across index funds and bond holdings. During the 2022 drawdown, she rebalanced quarterly as her allocations drifted. She didn't feel brave. She felt uncomfortable every time. But the mechanical discipline of the process meant she accumulated equity at lower prices throughout the year. By the end of 2024, her portfolio had not just recovered, it had outperformed her pre-2022 trajectory. The structure worked because she built it before she needed it. And that same principle applies to the one risk this playbook still hasn't addressed, because the cash cushion, the automation, the rebalancing, all of it can be undone in a single afternoon if the psychology problem isn't solved first. Here is something worth sitting with for a moment. The investors who get hurt most in a downturn are rarely the ones who didn't know what to do. They're the ones who knew exactly what to do and couldn't make themselves do it. Knowledge and behavior are not the same thing, and the gap between them has a specific neurological explanation that's worth understanding. Because once you see the mechanism, you stop blaming yourself and start building around it instead. The mechanism is called loss aversion. It was identified and documented by psychologists Daniel Kahneman and Amos Tversky in research that eventually contributed to a Nobel Prize in economics. And the core finding is this: the emotional pain of losing $100 is approximately twice as intense as the pleasure of gaining $100. Not slightly stronger, twice as strong, which means that when your portfolio drops $20,000 in a month, the psychological weight of that experience is roughly equivalent to the positive feeling you would get from gaining $40,000. The numbers are not balanced. The emotional ledger is permanently tilted toward loss. This is not a personality flaw. It's not a sign that you're too emotional to invest. It's a feature of human cognition that evolved over hundreds of thousands of years in an environment where losses were often permanent and irreversible. Losing your food supply, your shelter, your safety, those losses didn't recover. The brain learned to weight them heavily because the cost of underreacting was extinction. The cost of overreacting was just unnecessary caution. In that environment, loss aversion was the correct setting. In a modern investment portfolio during a temporary market correction, it becomes the most expensive cognitive bias you own. Here's where it shows up in practice. Peter Lynch ran the Fidelity Magellan Fund from 1977 to 1990, averaging returns of around 29% annually. One of the best track records in the history of actively managed funds. And yet studies of investor behavior during that period found that the average investor in his fund actually lost money or significantly underperformed the fund itself. The reason was straightforward. Investors piled in after strong performance when prices were high and withdrew during downturns when prices were low. They were doing the opposite of what the math required, not because they were irrational, but because their emotional response to short-term losses was stronger than their commitment to the long-term strategy. Lynch's genius couldn't protect investors from their own instincts. That pattern hasn't changed. Research published in 2024 tracking retail investor behavior during the 2022 drawdown found that net outflows from equity funds peaked within weeks of the market bottom. Investors were leaving at the exact moment the historical evidence suggested staying was most valuable. The same pattern, different decade. So how do you build around a bias you can't simply decide your way out of? You make the decision before the emotion arrives. This is the concept behind a written investment plan, and it is more powerful than it sounds. Before the market drops, you sit down and write out exactly what you will do at each level of decline. If the market falls 10%, you will continue your automated contributions unchanged. If it falls 25%, you will rebalance according to your target allocation. If it falls 40%, you will increase your monthly contribution by a specific amount if your cash cushion allows. You define the actions in advance, in writing, while you are calm and the stakes feel abstract. That document becomes the decision you already made. When the market is down 30% and the financial news is catastrophic, and your brother-in-law is texting you about moving everything to cash, you don't have to make a judgment call under pressure. The judgment call is already made. You just execute. Think of it as a contract with your future self. The version of you reading that plan during a crash is not in a good position to make clear financial decisions. The version of you who wrote it was. Give that version the authority. One more layer worth adding. Tell someone else about the plan. A spouse, a close friend, a financial advisor if you have one. Accountability doesn't eliminate the emotional pressure of a downturn, but it raises the cost of abandoning the plan in the moment. You're no longer just breaking a private agreement with yourself. You're explaining a decision to someone who remembers what you said when things were calm. The written plan, the automation, the cash cushion, the diversified and rebalancing portfolio, these aren't separate tools. They're a single integrated system, each component reinforcing the others. And now that the full picture is in place, the only thing left is to look at where you actually stand against it. Here is what this all comes down to. A recession is not a pause in wealth building. For investors who stay in, stay consistent, and stay structured, it is often the most productive period of their entire financial timeline. The fear is real. The instinct to protect is real. But the math runs in the opposite direction, and now you've seen exactly why. A few things are worth carrying forward. Losses and gains are not symmetrical. A 50% drop needs a 100% gain to recover, which means avoiding panic selling is not passive. It's one of the highest leverage moves you can make. Missing just 10 trading days over 20 years can cut your returns by more than half, and the best days almost always follow the worst ones. The structure matters more than the courage. Automation, diversification, and a written plan don't require you to feel calm. They work precisely because they don't depend on it. Watch your own reactions the next time markets get uncomfortable. Notice the pull toward action, toward doing something. That pull is the mechanism we talked about. Recognizing it is the first step to not being controlled by it. There's a deeper question sitting just beneath all of this, though. Everything covered here assumes you have money consistently available to invest in the first place, which raises something most people in their 30s and 40s are quietly wrestling with. Why, despite earning more than their parents did at the same age, does it feel harder to get ahead? That gap has a specific explanation, and it has nothing to do with discipline or spending habits. That's worth understanding next. If this shifted how you think about market downturns, share it with someone who goes quiet every time the market drops. They need the mechanism, not the motivation.